This is For Advisors by Advisors. I'm your host, Evan J. Mayer, and today we have a very special guest in Louis Diamond. How you doing, Louis?
I'm doing great, thanks. That studio soundtrack gave me a real ego boost. I appreciate it.
That's what we need to do. We need to get people pumped up before they get on the show. So we don't give you like the whiff of the smelling salts or anything like that. For those that don't know Louis, and if the name Diamond does not ring a bell, Diamond Consulting has been around since, I think it's since 1998. Mom started it, right? And you joined in 2015?
That's correct.
Excellent. And you are now the president, which I'm going to guess puts you in line to be the next CEO, but there's a bunch of family members there, so things could get shaky, right? Do we know what the progression is going to be yet?
No comment.
No comment yet. Okay, good. So the family business, dad's in it, right? Brother's in it?
Correct. Yeah, my dad, Howard, was a practicing attorney that really detested what he was doing. So he joined the business a little over 10 years ago to run the actual business of the business and be chief operating officer, free up capacity, something we see with many of our advisor clients. And then my younger brother, Jason, worked for Merrill and Morgan Stanley and kind of did the whole breakaway move. He wasn't an advisor, but wanted to work in a more entrepreneurial environment. And now he's my running mate, and we have a lot of fun together.
Excellent. So, yeah, your history shows that you actually were in the wirehouse for a little bit as well. Why don't you give our viewers a little background on your experience in the business?
Sure. So, started off with working on a couple of wealth management teams in an admin capacity. So, developed a lot of respect for the hard work that the admin teams do to keep advisors focused. Got a broad exposure to the business, and then worked for an ESG-focused mutual fund called Calvert Investments that was subsequently bought by Eaton Vance and now Morgan Stanley, and then did some management consulting with Ernst & Young for a few years, working with financial services companies before joining the family business back in 2015. And I like to say I never planned on joining the business. It was really, really far off my radar screen. Knew it was a great business and certainly provided a lot of amazing opportunities for us growing up, but call it wanting to be stubborn and do my own thing, or just having a different perception of what the business really was. It wasn't until I was kind of frustrated with the bureaucracy and some of the rote tasks of the consulting world and spending way too much time in Columbus, Ohio. No offense, people in Ohio, that I realized as I was describing what I wanted, which was something more client-facing, on the ground, having more of an impact in people's lives, that I was really describing this business. And it's an amazing business, and probably one of the best decisions I ever made was joining my mom at the time to partner with her and growing Diamond Consultants.
And you guys are based in New Jersey, is that right?
Correct. Yeah, we're based in New Jersey and New York City. And we, through the pandemic, hired a very talented gentleman in Dallas. And we work with advisors nationwide. So from an office footprint standpoint, it's New Jersey and New York, but we work with people in all 50 states.
It's interesting that you come in, mom, I guess you're younger than me and mom was older than me. So I'm kind of right in the middle. And I always like to compare myself I'm kind of a mixture between the next gen, because I'm Gen X, but I also understand the old school style and the old school world of things. Have you started to segment into that next gen, and how is the firm changing since the time you joined to where it is today?
Great question. Yeah, from the advisors that we consult with, I would say there isn't any age bias based upon where I am in my life or in my career. Certainly, it sometimes resonate better with younger folks, just like sometimes resonate better with older folks. But there isn't really any preference or bias that way. As far as approaching the business, I do think having a different kind of lens, a more tech-savvy approach has been helpful. We have been able to implement like a new CRM system, a marketing automation platform, and just do things a little bit differently because of the experience I have and just my familiarity with technology.
No more yellow pads, right?
No, I'm not a paper guy.
Yeah.
As anyone who works for us knows, I'm not a paper guy. But I think overall, it's more so just having kind of a new or kind of fresher perspective on the business. We can think a little bit longer term. And my charge as president has been to make this into a thriving enterprise, not just a business. We've kind of had the evolution that most advisors do, was a very successful practice, and then it became a business, and now we're on the path to become an enterprise.
Talk about the next gen advisor. Is there a difference in what they're looking for when they're making a move? And the reason I ask you this is that I remember, we've hired a couple new younger people, and they've asked questions regarding home work life balance and these kind of questions where when I was growing up, that was never really a thought. And I remember calling upon another advisor that was a younger advisor and asking him if he wanted to come over and he could make a lot more money. And he goes, Evan, I got to stop you there. It's not about money anymore. And I'm like, well, what's it about? So, and he mentioned this whole home work life balance situation. When you're recruiting, are you guys noticing that there's a very different mindset between the next gen advisor versus the advisors that have been in the business for 15, 20 plus years?
Great question. Well, first off, if I hear an advisor say it's not about the money, it's definitely about the money. I would doubt this individual who spoke to, just being facetious. But no, I think there is a big difference between the mindsets of advisors at different phases of their careers. Overall, we've seen advisors, regardless of where they practice, think about their businesses more as businesses. And with that, it's thinking longer term and just having a lens as, okay, where's the business going to be best for the next 10, 15, 20 plus years? A number of the teams that we consult with are originating from one of the major wirehouses. And we hear it often with those advisors that, you know what, it's good enough. I'm growing, the platform's really good, great technology, great brand, but it works well enough. I have 5 years until I'm retiring. I have my firm's sunset program ahead of me, and it's just not worth it because I can kind of suck it up. Versus those with the longer runway say, same thing. It's working, it works well enough, technology's good, platform's good, but I see handwriting on the wall with compensation plan changes or pulling out a protocol or fill in the blank with whatever is that advisor is experiencing. And I know that if I want to be in this business for a long time, it's worth it to kind of take a step back and transition to take many steps forward. So typically that age dynamic comes into play for, I guess, is it worth it to go through the pain and hassle of a transition, or is it good enough just to stay?
There's a growing number of advisors that I think the average financial advisor age is something around 61, 62. So I would think there's going to be a big migration change. And we hear a lot about that. Are the compensation structures in the wirehouses for the sunset programs, are those getting better, or are advisors missing the boat a little bit on going independent is maybe a lot better of an avenue to not only get their clients with the right type of advisor and the advisor of their choice, but also to the compensation aspect as well?
It's a really good question. I think the sunset programs are actually getting better because the firms are smart. They know their greatest retention tool are these programs. And if push comes to shove, an advisor prefers to go through that program than go through the risk and the work of a transition, especially when they're pretty close to hitting the golf course. So I think the deals are getting better. And honestly, they should get better because in very rare instances, is the firm actually putting their own capital behind the deals. They might bankroll the deal or underwrite it, but it's really the next generation team member or team members who are using basically the cash flow of the business to buy out the business over the next 3, 5, or 7 years. It's kind of like the evolution that we saw in the independent space, where before institutional capital came into the M&A space, it would be an earn-out based deal, right? Where if you're selling your practice to a team member, they're basically just going to pay you out of cash flow of the business for the next 5 to 10 years. That's kind of where that segment is. So to really answer your question, I think in many cases, advisors are somewhat missing the boat as far as the really compelling multiples, especially at long-term capital gains that's available on the independent side. But it does depend upon the business. If you're a $1 or $2 million producer, honestly, I don't think there's going to be that much of a delta between what your wirehouse will pay you to retire versus what you can get on the open market. Where we really see the delta are these larger practices where the multiples really expand, where if I'm a $1 billion group, I can sell for 12, 13, 14 times EBITDA. And then all of a sudden you're really dwarfing what you can get as a multiple of your trailing 12, especially when you take into account operating leverage and long-term capital gains.
Let's take a little different of a path here. When I was a bank advisor, right? And bank advisors tend to stay in the bank channel. So I don't think that they're, I'd love to hear your perspective on calling on bank advisors, but my guess is that a lot of them get very cozy with where they are, specifically the bigger producers. And the more they're there, the more likelihood they are to stay. But I remember the evolution I was going to take. And my evolution was always, I was going to be in the bank and then eventually cut a check, go to a wirehouse, and then eventually go independent. I ended up making the path from bank right to independence. And then this whole RIA side of the world kind of opened up, and it's like, hey, you could do this down the road too if it's of interest. And I'm happy in my channel, and I'm happy with the move I made. And it would never have made sense to go from a bank channel directly to an RIA. I think the move that I made was right. And the question is, down the road, does that evolution take place? Do you see that evolution as kind of the same? And what are your thoughts between the banks, the wirehouses, the independents, and the RIAs?
It's a great question. Yeah, it is I mean, look, what you just laid out as your thought pattern, it makes logical sense, right? I'll go get paid, monetize the business, put away a bunch of money. Ideally, I stay here for a long time. And then ultimately I can go and own the business when it's bigger and when I have more capital behind me to kind of take the risk. We still see that. You see younger advisors who say, you know what, I'll take a deal. It's a 10-year forgivable loan. I'll be 47 when it's done, and I have plenty of runway to go independent. But honestly, we've kind of seen somewhat of a shift where advisors just realized that they recognize what they want. And they're now, I would say, taking greater steps and being more deliberate with getting to the promised land sooner. So in the case of independence, it's okay, I know I want to be independent. Why wait? I can get a head start on building equity, growing the business. I'm seeing a bunch of friends do this and it seems really fun. Why delay? Kind of to your point earlier with what do younger advisors value differently? I somewhat agree that every advisor has some sort of financial motivation behind them. You have to. You're running a business and you're working in order to support a family. But sometimes, let's say, the mindset has shifted where it's not just a forgivable note is the end all be all. Maybe there's different ways that we could still make a lot of money, but also more importantly, have fun, serve clients better. Maybe just the order of operations has changed. So it's still popular to go through this evolution, but if we were counseling the team, we would say if you want to be independent, as an example, go be independent. Or at a minimum, go to a firm like Raymond James or LPL or Ameriprise or Wells Fargo, where you can go independent without having to repaper. And that tends to be a pretty popular option as well.
Are you seeing a lot about that? Because it's funny, there's Ameriprise advisors that are saying they're going independent, but it's really a franchise model at Ameriprise, where Raymond James is actually a pure independent type of situation. When you're talking to people, are you advising them on the difference between franchise and truly being independent?
Yeah, absolutely. I mean, our job is to give the pros and cons of any multitude of options. We have close to 400 different firms and platforms that we represent. So it's our job to kind of know the ins and outs. I mean, I would also say, though, that there are, of course, legal differences between being an independent contractor at a Raymond James versus being a franchise owner at Ameriprise. But in the end, both are going to be 1099s. Both are going to own their business. There are some differences in the length of the documents that they sign and some other freedoms that they have. But I would say it's more so on, do you want to be independent? And if you want to be independent, how independent do you want to be? There isn't that one's better than the other. There's different.
And I wanted to hop on that too. So Wells Fargo had their own independent chassis, and they were really getting a lot of traction. And I had heard this, I don't know how true this is, and I don't know if you've heard it, but I've heard they were expanding to that. Like Ray J almost has those 4 different models, and it kind of has everything encompassed. I think Ameriprise is trying to do the same. It looked like Wells was going that angle, but then I heard recently that they stopped allowing the transition to be from moving from the bank straight to the independent side. Have you heard of any changes there?
I think I've seen the article that you're referencing. I don't know firsthand, but I would say that it's the hallmark of their firm is being able to come over and then migrate to independence with scaffolding when you want to. But yes, we have heard that it's become harder. And I think more so because that approach was too successful. You had too many advisors that saw, okay, it's not that much different to have my own office space, but I can make twice as much and own my business. So logic dictates that you're going to see a lot of people do that. So I think their strategy was successful, but maybe a little bit too successful to keep up with the demand.
It's interesting how that works.
Yes.
Let's talk about broker protocol for a quick second. My theory has always been it's going to get fully taken away at some point because they're doing a lot of employee channels and salary channels, and a lot of the big firms, such as UBS, had that in place, took it away. What are your thoughts regarding broker protocol? Is that here to stay? Is that here in 20 years? Is that a thing of the past?
Yeah, great question. Yeah, I don't know if it's here in 20 years because who knows what Chat GPT is going to do to the world in 20 years. I'm still petrified because I don't understand it. But as an aside, I don't know about 20 years, but right now our philosophy is it's here and firms that are in it, and we'll say like the main staples of it, Merrill, Wells Fargo, Raymond James, all the independent firms, they're in it and there's no reason for them not to because they're both recruiting advisors and there's a benefit to it. And of course, they're losing advisors. I think what we'll see is an evolution of the protocol. We're seeing it now with Wells Fargo and Merrill as an example. Both are part of protocol, but if an advisor receives a referral from the bank, those pieces of business are exempt from protocol. So I think over time, you'll start seeing through new vintages of employment agreements, whether through retiring advisor programs or through leads and referrals, that protocol it becomes, I guess, not as relevant for many advisors. So I think it'll still be here in some capacity. I mean, or it's going to be litigated because we're seeing now with like non-competes are under fire. So who knows what the future of financial advisor employment looks like, at least on the legal side. But I think it'll be here because it still serves a purpose. But my prediction is it'll kind of get chipped away at or shifted because of just new circumstances.
Yeah, or as the next generation advisors come in and the sunset programs are getting better, as you say, maybe in those type situations, those are now exempt from protocol and then slowly, eventually eliminate protocol that way.
I don't think you're wrong. Yeah, I think that's the playbook. That's definitely the playbook that some of these firms are calling from.
So talk a little bit about you guys on your website. I had gone through your website and it's interesting. You have a little section that's specifically targeted on UBS and Merrill Lynch advisors. And your podcast almost is geared a little bit towards that way from what I've noticed. Talk about the thought there. Has UBS and Merrill ever said something to you like, hey, it feels like you're going after our guys only kind of thing? Anything to say on that?
Hey, all is fair in love and war, right?
Yeah.
No, but for really since our firm started, we've focused on the wirehouse community. And we made a strategic decision that's played out very well that companies like Morgan Stanley and Wells Fargo are clients of ours. So you can't, in many cases, recruit to and from a firm. So naturally, that's been our market, has been Merrill and UBS. And we still see a ton of movement from those firms and have for the last number of years. So I'd say our biggest avenues for business development are UBS and Merrill, but we work with advisors from really most firms across the street. And the firms haven't necessarily said anything to us, but we had Andy Sieg, who's the president of wealth management at Merrill, on our podcast a couple of weeks ago. So he's obviously aware of it.
Yeah, I saw that. But, regarding UBS or Merrill specifically, Merrill advisors, in my opinion, specifically the ones that are in their 50 to 65 range, I'm seeing a lot of them go independent and they're kind of sick of, I guess the bank one is what I'm hearing a lot, like the bank one at Merrill, and they're kind of getting done with the rules and restrictions. What are some of the key takeaways from Merrill and UBS that like, hey, it's different at Merrill and UBS compared to going independent? What are like 2 or 3 different things that you guys really harp on that, hey, that is not the way it is when you move?
Right. Yeah. I mean, first off, there's big differences between the cultures of UBS versus Merrill even. Just one is the largest wealth manager in the world. The other one is I think 10 to 15% of Bank of America's total revenue. So very, very different cultures and mentalities. But I would say with both, and this wouldn't be specific to Merrill and UBS, it's more just the model. If you're talking about someone who's going independent, if you're talking about business ownership in some capacity, you're talking about owning the book of business and owning the client relationship. You're talking about customization on technology. You're talking about doing what you're doing, having a podcast, writing market commentary, having a unique voice. And then if someone's going into the registered investment advisor segment, it's about true open architecture. So working with multiple custodians, shopping loans to multiple providers instead of being captive to a single source. And you're talking about access to a way larger segment of the market for alternatives and really any type of product. So that tends to be the conversation. I agree, many Merrill teams and UBS teams do go independent, but from our vantage point, from just our experience, and we just released a transition report about the full year 2022 advisor movement. Their data validated it. There isn't one channel of the industry that's winning or one firm that's winning. It's scattered. It's scattershot where the team's going to go. So we're just as likely to see a Merrill team go independent as they are to go to Morgan Stanley, as they are to go to Raymond James or go to First Republic. And it's fun. That's what keeps us on our toes. That's what keeps the industry humming. And honestly, why it's a seller's market for advisors, because there's far more competition for advisors than ever before.
It's interesting you say that because I've really seen an evolution in the independent side. But again, I'm on this side now. And so maybe that's why I've seen it. And so sometimes I wonder if I'm jaded. And I think at the end of the day, it all comes down to relationships and and what the people like it that are in your seat are advising to. And I think the question I have for you on this is that I always thought the numbers were exceedingly going independent. What did your research recently show?
It's actually not the case. This wasn't our research, but there's a consultancy called Tiburon. They're a management consultancy in the space. And don't quote me on this directly, but it's something like, I think it's only 5% of advisors across the industry who move break away. And that's across the whole industry. So that's including an advisor moving from Cetera to LPL. Like that's captured in that. So that's not really breaking away. It's still a relatively small number compared to the number of advisor moves. I would say for specific to wirehouse teams, at least with our business, I think we're pretty good practice for the market. It's about a third of teams we work with go independent, and then a third will stay in channel, so go wire to wire, and a third will go from a wire to a Ray J or RBC or a Rockefeller and go to a smaller firm.
You didn't mention banks there, and just coming from the bank channel and what I said earlier, is it just, it's a lot more dials. It's a lot harder to get bank advisors to pry away from the banks to go to the wirehouse or go independent. Is that a tougher sale?
I mean, honestly, we have limited bullets and limited time in our day, and we actually don't actively prospect traditional bank advisors, mainly because book portability sometimes is suspect, and the appetite from our clients is a little less. We still work with plenty of bank advisors, but usually they're folks who reach out to us, and we'll be somewhat selective with who we work with because bank advisors are already kind of starting a little bit behind traditional advisors. But the key is if the business is built by them and there's decent portability, we'll take a look at that all day long, but we just don't necessarily prospect from them.
Yeah, you bottom line don't need to. And I'm sure there are recruiters out there calling them anyway. So which brings me to my next question to you. What makes Diamond Consulting different than Rummage Group or the other groups that are out there? When I get a call from you guys, what is going to be my difference maker?
Sure. Yeah, I'm not familiar with the Rummage Group and I can't talk about their strategy, but how I know we differentiate from recruiters in our profession is that we actually act more as a consultant. So instead of having 3 firms that we're trying to put everyone into, we're very open architecture. We have close to 400 different firms that we can recommend to an advisor. So it all starts with what's an advisor looking to solve for, what are their goals, where are they trying to go? And then it's our job to match that up with what's available in the industry. So instead of starting with, hey, I'm calling to pitch you on X, Y, and Z, instead it's let's educate you on what's going on. Let's learn about you and your business. And if you're looking to make a move, we'll certainly help you through the process, but as a consultant rather than a transactional salesperson. So I think that's our differentiator is starting with the advisor, starting with their goals instead of ours, and then having probably the broadest platform of any firm because we are very comfortable bringing folks to W-2 models, to independence, to building RIAs, to joining RIAs, and everything in between. So no matter what an advisor is looking for, they're a good fit to work with us. We're very confident we can help them better than anyone can.
Excellent. Your podcast, it's a great podcast. First Mom was doing it. You've been instrumental in that podcast. A lot of times you guys get bigger advisors. I actually had messaged Mom when I went independent because it was, I'm sorry for calling her Mom, probably shouldn't do this. We're in business, right? So, but anyway, Mindy, and I remember messaging her and just saying, thank you so much for the podcast because the podcasts were truly helpful. You know, one of the interesting things from you guys is that you've actually helped some big teams move and you also help, smaller teams move. What are some of the complications with the bigger teams versus the smaller teams? What's the difference in strategy that you might have with a bigger team versus a smaller team?
Definitely. And I think what you're getting at before is we focus on larger advisors. It's somewhat by design. I think every advisor is growth oriented. So having folks on that are somewhat aspirational in their stories, how they built this tends to be pretty instructive. We still have plenty of episodes with guys with 100 million, 300 million, et cetera. But we think the best stories tend to be these larger moves. But I would say the complications for a larger team versus a smaller one, there's typically many more stakeholders. There's more advisors, more support team members, and just more folks to get on board, which is always a challenge. I think the other thing is the inertia is significantly more. So if you think about an advisor moving as kind of pushing a boulder up a hill, the hill is probably 90 degrees more steeper if it's a team that's making millions of dollars a year and doesn't really have to do anything versus someone who can gain a lot more. Maybe they can double their pay by going independent as an example.
Yeah.
Look, any advisor, even if you have 50,000 of production, a move is a major decision. It's their life's work, it's their income, it's their livelihood. And a move is tough. I mean, it sucks, honestly. Like you've done it before. It's a lot of work. It's a big haul. So we don't minimize the amount of work it is or the effort, but it is, I think, just harder to justify a larger team moving than a smaller one. Although in this environment, we're seeing just as many large teams move as small ones because the opportunities are that much greater for them than before.
Yeah, I'd say, well, it's interesting. I think one of the guys you had on was Sechin, who's on CNBC, and he had a big group, and then they started their RIA, and their RIA is a kind of unique, neat strategy that I was reading on. And it's interesting. You see a guy like that on UBS and on TV, you go, he got so big going through the wirehouse. You can do it in any channel you want. I guess the question is, when do you get so big where you don't maximize that by making that move? So he obviously maximized his value proposition tremendously by making that move, and some of the bigger people that you've had on the podcast. So
yeah, and look, our podcast is focused on the independent space. One, because I think there's a lot more questions about that than what's it like to go work for UBS, as an example. But also, independent advisors are allowed to talk to us on the podcast and on the record, where captive advisors tend not to be able to. There's plenty of really successful teams that will always be wirehouse teams. If they move, they go to another wire. And the wirehouse space isn't going anywhere. So I think you're just as likely to find a Rob Sechin running a RIA like New Edge as you are holding down the fort with a team at Morgan Stanley or Merrill or Wells Fargo. And that's, I think, what makes the industry pretty interesting.
Yeah, it is. It is. And it's interesting to see where things are going. Just to wrap it up, who should call you guys? There's advisors out there. It's 2023. We experienced a horrible market last year. This year, starting a little sluggish. Obviously, today, those comments, Howard mentioned, rates are not done. We're going to continue going up. Makes the environment tough. Is this the right time to move? And what argument can you make that it is?
Yeah, so to answer the first part of your question, who should reach out to us? I would say any advisor who's curious about the landscape outside of their current firm and or is interested in making a transition, but is looking for professional representation. So similar to how you hire a real estate agent if you're buying or selling a home, we're the same way, where of course you can go and find your own firm, similar to how you can pick your own portfolios by opening up a Schwab account. But we're really good fits for advisors that they want an expert on their side who's done this before, who can point out many of the pitfalls, can help compare and contrast, and I think more importantly, just save them time. So those folks tend to be the people that work well with us. We're open to speaking to anyone, but usually our focus is on advisors with portable books of business in excess of 50 million in assets, but our average is certainly quite higher than that. The second part of your question was about the wobbly markets, kind of the unpredictability of it, and is it a good time to move? Honestly, you can see that answer from two different perspectives. Change is hard for anyone. It's human nature to anchor to certainty and to what's familiar. So advisors always look for reasons to punt off change because it's hard and uncomfortable. So pointing to the market gyrations as an excuse is certainly something we hear. But just as many advisors also talk about how they actually think they're in a better spot to move because they've reminded their clients about their value add and their business is held up. Sometimes too, it's, I want to reposition my book at a certain time. I've even heard advisors talk about if they're going to get paid a deal to move, it's to their benefit to move when the market's down. Even though their business might be a little lower, they get all this money, they can invest it when the market's at a year low rather than at a high.
And they get a back end bonus potentially too.
Yeah, exactly. So there's no perfect answer. People put off change for many different reasons. Honestly, the market comes and goes. Every advisor knows that. It's more so about assessing the level of pain you're in. And if you are in pain, is there a model or a firm that's going to meet your goals more than just staying put? And if both those tests check out, markets be damned, people are going to move.
Yeah, 100%. I concur fully with you. It's actually a good way to reposition yourself that with rates going up and the change, specifically going independent, I wanted the freedom to be able to do some things that I think are going to be more beneficial for you. There's always a way to word it properly and also a smart way to put it. Lewis, thank you so much for joining. Any advisors out there, that's our audience. How do they get a hold of you?
Yeah, you can reach me at 973-662-4740 is my direct dial, or emails ldiamond@diamond-consultants.com, certainly through Google or our website. And yeah, really happy to talk to anyone, see if we're a fit, and at a minimum, just give you a quick perspective on what's going on. And honestly, we're agnostic. If someone is going to move or is moving, it's more so just about sharing what's out there and letting people make their own decisions.
And they can reach you on LinkedIn too. You're on there a lot.
Most definitely.
Yeah, excellent. Lewis, thank you so much. Appreciate your time today. Advisors out there, hopefully you gain some knowledge. They're a great firm. They've been around a long time. They have a wealth of knowledge. Feel free to reach out. And if you're ever looking to make a move, even if it's to a wire or back to independent side or IA side, it seems that they have all those angles. So thanks again, Louis.
Thanks for having me, Evan.